Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN Sunday. I'll be joined today by members of the media, academia, and financial services as we analyze all the news this week and what it means in retirement markets, technology, personal finance, so much more. You're not going to want to miss the show, so sit back, relax, and enjoy this episode of BRN Sunday. Let's kick things off with a look at technology. Joining us online, he is lead advisor, executive producer for 7 Investing. Let's talk to Daniel Klein. Dan, great to talk to you this morning. Thanks so much for joining us.
Hey there, Jeff. Thanks for having me.
Excellent. Before we start, how is the weather in your neck of the woods down in Florida?
It's taken a turn for the good. We had our winter, which is, days where it's in the 60s and maybe a little gray, and we are back in the 80s. It's actually made taking a walk less pleasant, but I'll take it.
Yeah, well, I think a lot of people out there are probably would love 60 degrees right now, especially if you're in the Northeast experiencing a lot of the winter storms. So keep enjoying that weather, and you might have some company once travel restrictions are opened up. So, Dan, I know you wanted to talk about SpaceX and, in particular, internet availability. So what can you tell us here?
Yeah, so this surprised me. So SpaceX, which is an Elon Musk-owned company, they do a few things, but one of the things they're trying to do is launch 10,000 satellites into orbit to provide, let's call it satellite internet, but it's much easier satellite internet than previous satellite internet. What does that mean? The old satellite internet, you needed like a dish, sort of like a DirecTV dish, had to be mounted on your house. This is more, you have a dish, you could put it on like a table outside. And I thought this was kind of a hype thing, something that was never really going to happen. But they are taking pre-orders for the $500 kit. It's a $99 refundable deposit. And I actually have a friend who set his brother up, I believe in Vermont, with the service, and it provides viable internet. Why is this important? Well, 2 reasons, Jeff. One, there are parts of the country that simply don't have good internet. My family home in New Hampshire has the old kind of satellite internet, and it's very slow, it's very expensive. You can barely watch a Netflix movie. It's not that great if both of us are working, or God, if there are more people in the house, it can get really slow. This is much better service, but here's why it's important. So I have Comcast. They are my internet provider. And this week, my internet went out. I was working, watching TV at about 8 in the morning. It disappears, and I go on their website, and it says, hey, no problem. It'll be up at 11:40. And I went, well, that's not a big deal. I'll go to the gym at 10. By the time I come back, it'll almost be up. Well, they kept moving the time out until finally they moved the time to we don't know. And while their Twitter customer service person was nice, nobody was very helpful. Why am I bringing this up? Because I don't have any choice. Comcast is a monopoly internet provider. About 40% of the country has no choice. About 60% of the country doesn't have a reasonable choice, meaning there's like 20% that could get something else. And in my case, I don't have a great T-Mobile signal in my new house, which doesn't matter usually because I have Wi-Fi, but I tried tethering to my phone, didn't work. I had to use a mobile hotspot that worked enough to like check email and work a little bit. But if I had the option as someone who works from home of spending even significant money on backup internet that was, satellite based, I may very well do that. And a lot of people might use that to leverage a better price from the Comcast of the world, which, look, they don't have to treat you well because what choice do I have? When I said, hey, my internet's down, it's a pandemic, I'm trying to work, my wife's trying to work, my son's going to get home from school, he's going to have to do schoolwork. And they said, yeah, we appreciate that, we're trying hard, without giving us any information. Do I believe they were trying hard? No, I don't. So I think Starlink, and there are some other companies doing this, could become an option. One of the things that Elon Musk talked about
Same thing.
is that when they have,
Pretty
no,
much.
I trust Bezos a lot more than I trust Musk.
Well, I'm talking about in terms of dollars that they have,
Yes,
and that's what I
but
meant.
but what Musk said is when their cash flow stabilizes, they're going to IPO, and I know a lot of people want in on this. I'd be really, really careful about that. I understand betting against Elon Musk has been a bad idea, but I think this solves an interim problem. Because right now, all the wireless carriers are rolling out 5G. We have 5G in much of West Palm Beach. And in places where you have true 5G on my iPhone, if I'm like waiting to go into an appointment for something and watch a movie and the parking lot has true 5G, Netflix is awesome. I don't think it's that crazy to think that in 5 to 10 years, that every part of the US will have the option of your internet being your phone and not a separate internet service.
Hmm.
That might make Starlink somewhat irrelevant. Again, it's going to depend on your needs. If you're broadcasting, you might need Starlink. If you're watching Netflix and surfing the internet, it might be just fine to have a true 5G connection. But here's the great thing: competition is coming for these legacy companies. And I get it. It made sense. In 1983, when where I grew up, Swampscott, Massachusetts, whatever year it was, got cable, they talked to the 3 or 4 cable companies that existed. And the cable company said, well, we're going to have to put all this infrastructure in. So we want an exclusive contract for 10 years. And then when
Yeah.
the 10 years was up, they went, well, we own all this. Like, so if you kick us out, like, we're taking our stuff with us. They had that leverage. They don't have that leverage in cable anymore because of streaming and the ability to cut the cord. They still largely have that leverage when it comes to internet, but I do think we're in the early stages of that going away.
All right, Dan. Let's very interesting, and I think obviously we want the best service possible. When I go out and look for internet service or any service, I want the best provider at the most reasonable price. And I would argue I've had Comcast and some of the other providers, and I'm really happy right now with what I have through AT&T. But that's a whole nother issue. Let's talk about Uber because Uber, one of those companies, lots of companies hit hard during this pandemic. One of those was Uber. What can you tell us?
So this is one of my favorite headlines I've seen because it was essentially sold as good news. Uber only lost $6.8 billion. Now,
Unless you're a shareholder.
I'm oversimplifying, and it's less of a loss. That's why it's good news. And Uber has had success with its delivery business. And right now, ride sharing is generally not as, it's much, much less than it used to be. And that will rebound. Here's the problem: Uber and Lyft compete with each other for rideshare, and that's going to keep prices artificially low. We've talked about this before, that getting an Uber should be 10% cheaper than getting a cab and 100% more convenient. It shouldn't be 80% cheaper. And because of the existence of Uber and Lyft, it is 80% or 50%. It is way too cheap, and they have no ability to raise prices. When it comes to food delivery, Jeff, I have 7, maybe 8 separate food delivery apps on my phone, and I'm not loyal to any of them because I'm picking based on which restaurants they have. So if we want to get barbecue, I might use DoorDash. If we want to get Chipotle, maybe 3 of them have that. The Chinese place I like is only on Uber Eats. Like, it's really, really confusing. That is an industry that I don't think long term is viable. And eventually, of course, there'll be robo drivers, it'll be automated, and then you don't have people, it becomes viable. But there's so much competition. It's such an add-on to the price of your meal
Hmm.
that we're seeing a huge boom in restaurant delivery, which helped Uber cut its loss. But post-pandemic, if I'm getting takeout 3 nights a week, and I think it's fair to say I'm getting takeout 3 nights a week, I'm going to go back to eating out 2 nights a week. That is going to cut into the Uber Eats business, and all the competition is still going to be there. This is not a good business. And I think people think because they like the product. I love getting food delivered. It's super convenient. I use Instacart, even though I'm paying who knows what kind of markup, if I'm having a grocery or a liquor order or whatever it is delivered, I'm still using it because it's easy. But when there's not a pandemic and I don't have to put a mask on and I don't have to be careful and not stand near people, we're all going to go to restaurants and the volume for these businesses are going to fall. So again, just because you like a product doesn't make something investable. And I don't know how Uber loses this kind of money when it's just an app where they don't even have labor costs, but obviously there's way too many people working there. There's way too much infrastructure. And this sort of arms race they're in both of their core businesses, you don't want to be in a game where there's very little barrier to entry, where here in West Palm, there's not only every national player, there's also at least 2 local players that I could think of. It's really, really tricky.
Dan, how did restaurants do? I've been reading about how the expense to have these like the Grub Hubs, etc., actually have really hurt some of the profitability. But you're closer to this than I have. So yes, they're getting volume, but are they really?
So the bigger chains have more leverage. So if you're McDonald's, giving your delivery business to 1 or 2 platforms gives you the leverage to have it be a positive.
Mhm.
If you're Starbucks now, Starbucks, I forget which platform they're on. It's generally a $4.99 order cost, so it kind of only makes sense if you're with a group, and we're largely not with a group. I've had 1 or 2 times where it was just like I needed a coffee and I ended up paying, $11 for my latte. Like that's not a viable business. But who does delivery well? You know who does delivery well? Domino's. They control it themselves. They have a massive network, and they can keep the costs down.
Mm.
I think you're going to see more companies either take it like BJ's, which is a chain, like a Chili's kind of chain, but it's better food. They use third parties, but you can place the order through their app and they control the experience. It means it's a lot easier for them to update their menu and have specials and things like that. And they're on every platform, and you never know who's going to deliver it until they actually tell you who's going to deliver it. But that gives them a lot more recourse if something goes wrong. So I think the local little guys have been fighting back a little more. I know some of the places here are only doing pickup because they can't make it viable. And I do think that's going to be a problem. You also see, and this is our giant problem, you see restaurants that you'll look and you're like, I don't think that menu's right. And you'll realize they're not willingly on the platform. They've been added to the platform. And when you place your order, somebody from, whether it be, Uber Eats or Grubhub or DoorDash or whatever it is, somebody calls up and places your order. And the problem with that is that's an inaccurate menu. The prices might not be right. Like it's a really tricky game. So it's a cutthroat business. And I'm not sure at the end of the day, unless we see massive consolidation, and I mean consolidation to one, that it's ever going to be viable for most restaurants, and if it's going to be viable for these companies. This is not an area I would touch as an investor.
Well, it's going to be interesting to see, Dan. Lots of so we talked to internet, and then we also talked Uber and food. I'm getting quite hungry, and I really love my internet. Dan, great to talk to you as always, and we look forward to having you back on the program again on Tuesday to talk more tech. Take care and have a great rest of the weekend.
Jeff, I'll see you Tuesday.
Welcome back. Time to talk healthcare now. Joining us on the line, she is the healthcare editor for Business Insider and also the editor of Dispensed, which you can find on the Business Insider website. Let's welcome to the program Lydia Ramsey. Lydia, thanks for joining us on the program this morning.
Of course, of course.
So, lots going on I'm sure, with the COVID vaccine, COVID pandemic. But what's top of mind when you look at the pages of Dispensed this week?
Yeah, for sure. I mean, thinking about the pandemic, I feel like we're in this moment where case counts are going down, which is something we haven't been able to say since probably November. And so that's exciting to see it. And we're also seeing more and more people get vaccinated, which is also great. Yesterday, the Biden administration came out and explained that they had purchased enough vaccines to get, I think it's about 300 million Americans, which is most of us, vaccinated by July. So that's quite exciting to think about. There's a vaccine at the end of this tunnel. So that's been, the optimistic side. But, on the other side, kind of always in the back of my mind is the emerging variants we're seeing popping up around the world that are coming here to the U.S. It's one of those things where I'm excited to see what happens with vaccines. But I'm also, cautious and keeping myself under the assumption that, vaccines aren't going to be the kind of cure-all that we might have expected them to be when we first started seeing data about them back in November.
Yeah, I mean, I was kind of perusing Dispense this morning. This even though we have a vaccine, the virus isn't just going to go poof and go away, right? I mean, this is going to be with us for the long haul, I would suspect.
Right. Yeah. So because the vaccines, J&J, I think we talked about this last time, J&J came out with their data and their vaccine wasn't quite as effective as Pfizer and Moderna's, in part because the vaccine didn't do quite as well against the emerging variants. Mm-hmm. And that's something to really think about when thinking about where the pandemic goes from here. If the vaccines aren't quite as good at confronting the variants, and if we get more variants over the next couple months, next couple years, I'm thinking a lot about it as kind of becoming the new flu. Yep. Maybe we'll have to get booster shots every year to kind of fight off new variants, new strains of the coronavirus. So I personally have been grappling with this idea of what happens when this pandemic goes from a pandemic to endemic, this idea that it's going to be here for quite some time. And
that makes a lot of sense. any thoughts when you're talking with people? I mean, in terms of dealing with this. I mean, dealing with that. I mean, you mentioned booster shots, and we get booster shots today for tetanus, for a lot of diseases. Plus, we get many of Americans, not all of us, get flu shots. I mean, is that what you're thinking when you talk to some of these experts?
Yeah, that sounds to be the consensus. What's going to be kind of funky is, thinking about when do we stop social distancing? When do we start sending people back to the office? Is it when people have their shots? Is it with their shots and masks? And a lot of that still needs to be proven out, right? Like, we need to fully understand whether or not the vaccines prevent transmission. That's been something that's been hypothesized as being true. But until we really know, it definitely muddies the water a little bit. But the good news is that the vaccines do seem to be protecting people from getting seriously ill, which is a common refrain you hear a lot for the flu vaccine as well, even when it's not quite as effective.
Yeah, I mean, even if it's 60-70% effective, I would take that over zero. And experiencing what we experienced throughout 2020, especially early on when people were dying, we had no ventilators, all these other things were popping up, and it was just a horrific experience. Lydia, let's turn our attention away from the pandemic for a second. And want to get you beyond just I know obviously COVID is top of mind for so many, but you and the team also cover a lot of news just in general with healthcare, with startups, with IPOs, other things that are happening. What else is going on in the healthcare sector that you and the team have seen?
Yeah, you mentioned it a little, but something that has been a constant refrain over the past couple of weeks is a lot of companies starting to go public in different ways. They're doing it through traditional IPOs. Oscar, for instance, last Friday dropped its public filing. Well, that was a lot of fun to look through and see what's under the hood there in a way we hadn't before. And 23andMe, the consumer genetics company you might know from like Ancestry and health screening tests, they're going to go public via a special purpose acquisition company, a SPAC, that's backed by Richard Branson. So that's kind of exciting. They haven't released their filing yet. They get a couple of more weeks after announcing. So I'm super excited to look through that once it's available.
How long are those documents? Just I've never perused through them. I'm not a stock analyst, nor am I a reporter. But how long are typically those filing documents?
Oh man, they can be hundreds of pages long, but the fun thing is trying to find the interesting bits within all the legalese or the stuff that they have to put in, which is a fun challenge, but it's cool. You get to find out. These documents can tell you so much about the financials of a company, how much money they're losing, what undue risks might be presented for the company. You start to see who are the big investors, how much they might make off this IPO. It's a lot of interesting stuff.
Yeah, I can only imagine. Well, Lydia, I really appreciate you spending a few minutes with us, and appreciate you putting together Dispensed. I know that you have a huge following, and I appreciate being able to see what you all are covering every week. Have a great weekend, and we'll talk to you again in a few weeks.
Sounds great. Thank you.
Bye-bye. Welcome back. Now we're going to check in on real estate. Joining us on the line, he is the intrepid real estate reporter for DowJonesMarketWatch.com. Let's welcome to the program Mr. Jacob Passy. Jacob, great to talk to you as always. Thanks for joining us on the program this morning.
Yeah, glad to be here.
So we were just chatting before we went live about the Super Bowl, and neither of us had a dog in the hunt, but Florida is such a great place. A lot of people are moving to Florida, but I wanted to ask you to check in on real estate. What's happening in the real estate world these days?
Yeah, no, I mean, definitely, definitely markets like Florida are very popular these days. You're kind of seeing, a lot of focus on the Sun Belt states that kind of stretch from Florida through Arizona, really in high demand.
Mm-hmm.
One interesting thing I looked into this week, kind of inspired not actually by a real Super Bowl commercial, but by a fake commercial, a commercial that, one of the fake spoof commercials that aired on SNL the night before the Super Bowl.
Mm-hmm.
They did a spoof of where it was kind of like a adult phone service ad, where they were making fun of how millennials are obsessed with Zillow, and how folks, these days go to Zillow to look at, fancy real estate listings as like almost a hobby. And it's, frankly, something I'm guilty of. I have definitely found myself on, Zillow or Realtor.com, just scrolling through the listings of homes for sale, envisioning myself, in my hometown in Florida, I could, for what I pay in a month in rent in New York, I could, afford to buy like a 2-bedroom townhouse and, all the trappings that come with it. So, it is definitely a phenomenon. And so I this week I took a look at that, what's going on here, why is it a phenomenon, and what's really driving this?
Yeah, so, I mean, it's almost, I was reading, I don't know, someone had an article about this, and I saw the headline, and it said, it's almost like, don't take this the wrong way, everybody, but it's almost like porn in that, people are like just tuning in and going to Zillow, and my wife is guilty of it. My wife, we're cautiously looking at the area and looking at something, and she's out there all the time looking at it. So, Jacob, I mean, you looked at it. What can you break it down?
Yeah, so I mean, there's definitely an extent to which it is a form of, daydreaming, of, escapism, and especially it's become really popular during the pandemic. I mean, it's funny because Realtor.com, Zillow both talk about how their sites are getting record amounts of traffic. And certainly, obviously, a lot of that is people actually buying homes and looking for homes to buy. But a lot of it is like, especially as we've all been cooped up at home, this, the experts I spoke with were talking about how this has given us an opportunity to think about about our home, what we want one day, et cetera. And so, if you live in a big city like I do and are, in a cramped, small apartment, although actually I'm lucky and I have a 2-bedroom, but I have plenty of friends who have 1-bedroom studios. If you're cramped in a studio apartment all day, of course you're probably going to want to look at Zillow and dream about what your life would be if you had a large backyard, things like that. But also, under all of that, like daydreaming, escapism, et cetera, there is, and this is something I teased out in this story, there is a real trend going on of of millennials buying homes. And I think that what gets lost in all the joking about sites like Zillow, and, I feel like there's been this kind of misconception that millennials aren't interested in buying homes. And that's not the case. I mean, most millennials are now, pretty much all millennials are now entering their 30s. And that is, the prime home buying, kind of age range is like, from your 30s to your 40s. And the fact of the matter is, it's not that millennials don't want to buy homes. It's just that for various reasons, including, the last recession and student loan debt and the high cost of rent, that dream has just been deferred slightly. It's been delayed. And so when we see these trends of folks, daydreaming on Zillow, what's really underlying that is that, ultimately the quote unquote American dream of a white picket fence and, a large backyard is true for most people still. And so there's an extent to which this trend is really a reflection of really how much demand there actually is in the market right now. It's showing how many people really do want to become homeowners. And that's, good and good news for sellers, bad news for other buyers because it means more competition.
Yeah, and to your point that we've talked about, as long as the show's been around, I mean, there's just a lack of surplus. There's a lack of inventory for people. So you're right. It's people want to buy. The question is, what do they want to buy? Where do they want to buy? You bring up the picket fence, and I can tell you, speaking from personal experience, I don't want to have to do the lawn around the picket fence, Jacob. So I like the idea of the house, but I don't want to have to do the lawn or pay the HOA fees.
Yeah, well, I mean, I don't know. It's probably one or the other, although maybe these days with sites like TaskRabbit, you can find a middle ground where you can hire someone, for cheap to just push your lawnmower for you.
Yeah. So, I mean, look, I think they're great sites. And how exactly does a Zillow or Realtor.com make money? Is it from the listing? So when you list your organization, your real estate, you pay something to list it, or is it for someone like myself who just wants to peruse it?
Well, Zillow is a complicated company in particular because they have so many business lines at this point. They have Zillow Offers, which is their own, we've talked about the iBuyers before. These are companies that, buy homes directly from buyers or from sellers and then flip them basically. And so they're not really doing any improvements or anything like that, but they basically will offer you a certain price. It's a pretty seamless process, for the seller, there's an appeal because you don't have to host an open house, et cetera, et cetera. So, they have that segment of their business. They have a mortgage lending side of their business. They now actually are a brokerage in a lot of ways. I mean, they have their own, they're building out their own brokerage network. And so they have so many different business lines to get revenue. And then, I can't say for certain what the fees are, but, certainly they are, making some sort of profit off of, the ability to list on Zillow. And Realtor.com is similar. They have multiple business lines as well. They're kind of, or not Realtor.com. I guess Realtor.com. They're also news oriented. They also have advertising on their site, I believe. So again, kind of a multifaceted approach. The listings, are the primary driver of eyeballs to their website, but not necessarily at both of these companies the primary driver of revenue per se.
Yeah, well, look, they're great sites, and I think people should aspire to greatness, and that's part of the American dream. I guess I'm guilty too of looking at them, and I particularly like new construction, Jacob. That's just my thing. But
I also want to say,
sure.
While we're all guilty of this, don't feel guilty, because the one point that the experts I spoke with made is that this may seem like a guilty pleasure type task, but at the end of the day, you're actually learning a lot. I mean, these listings, I heard from, friends of mine, after I posted this story, friends of mine who've bought homes recently who were like, I was guilty of that. But at the end of the day, like going on that site, going on Zillow all the time, like for fun, when it came time for me to actually buy a home, like I knew what I wanted. I knew what I wanted out of a home. So it helped narrow down my do's and don'ts lists or pros and cons lists. And also you get, it's not just pretty photos. There's information on the home values and stuff like that. So you can have a better sense of, what's going on in your market from doing what is, kind of a guilty pleasure activity, so to speak. So the folks I spoke with were saying that the, millennial generation of buyers might be the most well-educated home buyers the country's ever seen because of the fact that so many of us have turned this into, a leisure activity, so to speak.
And there are a lot of millennials. I think it's got to be the largest generation, largest cohort, right? I mean, by numbers, sheer numbers. Well, really interesting.
Largest generation.
Yeah, really interesting stuff. And Jacob, I'm going to be, this weekend, I think during President's Day, I might actually peruse Zillow and Realtor.com with my wife. Until then, thanks a lot for your time, Jacob, and we'll look forward to having you back on the program again very soon, my friend. Welcome back. Now time to talk markets. Joining us on the line, he is the lead host for the TD Ameritrade Network, and you can see him on Markets on the Close and Morning Trade Live. I think I got that all right. Mr. Oliver Rennick. Hey, Oliver, how are you?
Doing well, Jeff. Another fun, exciting week and a long weekend ahead, which will be nice.
Yeah, for those of us who have companies or work for organizations that take President's Day off, we get that long weekend. Oliver, you got your nose in the markets each and every week, each and every day. Give us your top 3 themes for the week.
Right now, there are a few that are continuing, which is the market's processing of reopening trends. The other one is the market's froth that is building up, that is extremely elevated in terms of sentiment and activity. And then the third one is more kind of like a analysis that I was doing this week with VIX that's kind of interesting. So just to kind of quickly touch on the importance of each is the first is pretty obvious. COVID curves are going down. That's really good. Vaccinations are going up. That's fantastic. And we do see this reflected in some areas of the market, namely crude oil rallying, bond yields climbing. That all works in line with the notion of a recovering economy that will be aided by an expected stimulus bill. So that's kind of the main thing that we're processing. Now, it hasn't led to a big hopeful push in back to normal stocks like cruise lines. To some extent, airlines are doing okay. So there is that distinction where there is still a great deal of doubt around specifically travel, but in terms of overall economic recovery and momentum building, that certainly is probably one of the most important themes, and well justified for the most part by the data, especially the COVID data. And then the other one is just the froth in the market, which, what else is there really say after GameStop and all that? We just print new highs basically every day. Flows are at extremes, positionings are at extremes. Bank of America's flow show report, which I follow, I think is the best gauge of sentiment, is right near its sell signal and the highest it's been in a couple of years. So it all adds up there too.
So, what do we, is there any period of time that, obviously this pandemic is unique, but is there any other period of time in the markets that you followed since your birth, I guess, in history, when you look at history, that this kind of mirrors? Like, I mean, this is when I hear froth, when I hear speculation, I immediately go back to a time that was really a big part of my life, which was the tech bubble. That was really the first time that I really saw markets really speculative, and I saw the negativity of that at the end of the bubble. Does this is what is going on right now remind you of any period of time in history?
So we were talking about this week with Randy Frederick from Schwab, and he has been following the basically day by day, tick by tick recovery of the S&P 500 now versus post-financial crisis, and it's creepy how similar the two are. But this is very different of a crisis because there was no real overwhelming amount of speculation that ended it. Generally, crises occur because there's too much speculation and the Fed hikes rates and risk assets drop or bubbles pop, housing bubble pops or bubble pops. So what we've gone through already is very unique, right? Because we basically shut down the economy on ourselves and we had this economic crisis. So that's in the rear view mirror for the most part. But now we have what one could easily argue is kind of a second potential crisis building around speculative activity and bubbles forming that do look much more similar to a dot-com style level of speculation. We've seen that in a lot of different metrics. And this week for my newsletter, I actually wrote about what we're seeing in volatility, which is kind of a nuanced thing, but I'll kind of give you the top line takeaway, which is that the VIX is the measure of volatility for the S&P 500, and it's been elevated above 20 for the entirety of this recovery. It's been elevated above 20 since the crisis began in February of last year. And that is second only to the great financial crisis when VIX remained that high for that long. But the comparison doesn't really work to the financial crisis because the market was still very much depressed off of the pre-crisis highs after the housing bubble. Nobody knew that the bottom was in, and so VIX was still elevated. What's happening right now is different because the VIX is elevated, but we're way above our pre-crisis highs on the market. The market's the highest it's ever been. Valuations are the highest it has ever been by many standards, even beyond .com. And that is actually more similar to .com. So .com, we had a lot of days in which the VIX was trading above 20. It didn't string together as long of a streak as we have now, but the idea was that we were making new highs, and VIX was also elevated during the .com period. So that, to me, is a very interesting comparison. And basically, it's happening because there's so much speculation. People are buying up call options and getting bullish on options, and that's keeping the VIX elevated. So some people think about the VIX as a fear index. It's not really what it is. Volatility cuts it both ways. Volatility is to the upside. It's just so extreme to the upside that it's keeping volatility elevated similar in a fashion that it did to the .com bubble. Mm-hmm. And I get into in my newsletter about what that might mean and what that means investors might want to look for, because it could be a very interesting comparison and maybe even a tell for when some of this speculation starts to slow down.
Yeah, I just, what we learned, what I think I took away from the GameStop thing, and I would be interested to get your final thought on this as well, is that there's like always multiple sets of investors when these types of things happen, right? You get the institutional people, and they've got so many resources, and they drive a lot of the market. I'm just giving you my perspective. You can tell me if I'm wrong, not a problem. And then you've got the institutionals, and you've got these people who were on the Reddit chat, and they were kind of driving things. And then you get people who get in at the last minute, and the people who get in the last minute, there's the ones who get hurt more than anybody else, in my opinion. But I'll give you the last word on that.
Yeah. No, that's how it is. The bubbles are asymmetric. They create more losers than winners. You're right.
Yeah. Oliver, always a pleasure chatting with you. I love the three themes. I mean, you just break it down in a way that I can understand, and I guess that's because you do 6 hours of programming plus a day plus your preparation.
Oh, thanks, man.
It's awesome. Oliver Rennick, pleasure to talk with you. Enjoy your weekend, and we'll talk to you again very soon.
All right, thanks, Jeff. Later.
Bye-bye. Welcome back. Now time to check out what's going on Capitol Hill, legislatively, regulatorily, and even with litigation. Joining us on the line, he's one half of the Legal Eagles. We're joined by Kevin Walsh. He's a principal with Groom Law Group, an employee benefits law firm based in Washington, D.C. Kevin, great to talk with you. Thanks for joining us this morning.
Jeff, it's always good to be on the show. I'm hoping that spring gets here eventually. In D.C., we've had 2 snowstorms the last week, and we're expecting to have a third this weekend. But I'm guessing listeners aren't here for the weather forecast.
Well, I hope that for your sake that spring is right around the corner. Kevin, I know you wanted to talk about some recent cases, and I'm sorry that you couldn't be joined by David Levine. The two of you together are probably one of the funniest and smartest tandems together around retirement benefits. But go ahead, take us through.
Yeah, well, I know David wanted to be here, but unfortunately for him, as a practicing attorney, he got called away to other matters. But yeah, this week I want to talk a little bit about cybersecurity. It's a topic that comes up all the time because it's near and dear to my heart. Anytime we're talking about additional responsibilities that plan fiduciaries have, and near and dear to my heart because I think that when the bargain was made that an employer was going to offer a retirement plan 40 years ago, or 20 years ago, or 30 years ago. I think the thought process was, I probably have to keep some records. I probably have to make some contributions, and I probably have to, allow people to have a way to make investments. Mm-hmm. And it seems like with each passing year, we're trying to come up with more things that plan fiduciaries should be doing. So, if it wasn't enough to be running your widget company while doing those things, you've heard me, I'd say talk, but others would say rant about, that new duty to, look for people and become like a private eye with missing participants. But in litigation, we're now beginning to see also, allegations that these planned fiduciaries, and this is what the plaintiffs are alleging, have another responsibility. And essentially the responsibility is that they've got to, engage in cybersecurity practices that prevent participants' assets from being stolen or that prevent, bad things from happening. To information about people who participate in plans. So if you thought that an ERISA fiduciary wasn't busy enough already, or if you thought that the rules of the game should be set when you start the plan, well, every day we're seeing pressure to say you're a plan fiduciary, you've got to be a prudent expert, and you've got to be a prudent expert in even more things. On the cybersecurity front, one thing that we've been watching is litigation, and there's this case Bartnet versus Abbott Labs, and there. A participant had about $260,000 taken from their account. The cyber criminal called the record keeper up. The cyber criminal was informed that the cyber criminal tried to change the account that the deposits were going to. The cyber criminal learned that when an account's changed like that, the distribution account, you can't take a distribution for a week. So a week later, the cyber criminal went back. Requested a distribution, had the distribution processed, and so the plaintiff, the person who lost their money, is saying, "Well, I want my money back," and they're saying, plan fiduciary, you screwed up when you picked this record keeper, and you screwed up when you picked this record keeper because this record keeper had been attacked by cyber criminals on 3 prior occasions, with or without success, and related to different plans. They're also accusing the record keeper of screwing up, but this week's decision is focused on going after the plan fiduciaries. And what's really nice here for the plan fiduciaries is that the district court said, come on, a plan fiduciary can't possibly, supervise everything there is to know about, what a record keeper does, and says, come on, the fact that there were 3 prior attempts against this record keeper, there's prior attempts against every record keeper.
Yeah.
There's nothing so shocking about, what this record keeper did in other cases that should have put these plan fiduciaries on notice. And more importantly, and here was what I thought was really interesting. It talks about a plan fiduciary's duty to monitor, and it focuses on, they've got to monitor with respect to the services provided to this plan, as opposed to monitor the services provided to other plans. So if you pick a record keeper and they're doing a great job for you, and you've heard of one-off events where others have been unhappy customers, it seems like the court here was at least saying, what you've got to look out for is how they're treating you, not the fact that there might be 1 or 2 unhappy customers out there. And this is helpful now. Now the plaintiffs are given an opportunity to refile their complaint. So, we can be back talking about this case again. Parts of the case against the record keeper have been allowed to go forward. But this is a welcome development if you're a plan fiduciary, because it's at least one more court signaling that, your duties with respect to cybersecurity aren't limitless. And I think there have been some fear that any breach automatically gave rise to liability. And district courts are beginning to say, plan fiduciaries have a lot on their plate. They've got to do a good job, but we're not going to say that they're at fault every time.
Yeah, Kevin, as I'm hearing you describe this in great detail and very eloquently, I might add.
Way too much detail.
No,
Way
great
too much
detail, but
If I had Levine here to bounce it off of, he'd have cut me off 4 or 5 times.
Yeah, he would have cut you off. But I think it was very elegant and eloquent in how you stated everything. So I just want to point it out there. But I guess
I try to be an elegant guest.
You are very elegant, very smart.
Elegance is the goal.
Elegance is the goal. Well, you have met that criteria. But Kevin, this case, this concept is not just, I would think, and I want to ask you this because I'm not an attorney, this is not just retirement. We're talking about a particular retirement benefit and a particular retirement plan, but this could happen with your healthcare plan. This could happen with some other voluntary or involuntary or voluntary benefit, I should say, right? I mean, this is something that is not just happening in the retirement space, I guess is my point.
Well, this is something that happens basically everywhere. Anytime you've got a pool of money that people can access, and we want people to be able to access, we run the risk that someone's going to fraudulently pose as that individual, that somebody's going to gain access to somebody's password for whatever reason. I mean, I get those notifications periodically from Google letting me know that it's time for me to change my password because somebody from, somewhere else in the world was trying to log in. So it's something that can happen anywhere. And we've got emerging standards, and at the end of the day, the folks who are victims of cybercrime are sympathetic, and it's frustrating. And I've been a victim of cybercrime. Yep. But on the other hand, if we want to allow individuals to access their money electronically, or if we want to allow people to have electronic access to records, it's a risk that can't be entirely eliminated.
And Kevin, in terms of those committee meetings that you, Dave, and other attorneys attend, this is just one other thing that has to be talked about, right? I mean, traditionally, you've been in those meetings, I've been in those meetings. It's investments, it's new laws and regulations, but things around cybersecurity, around contracts, around fees. I would imagine where do they stand in terms of the generally speaking, not particularly to one client, but in terms of the pecking order of things that you go through in a meeting.
I mean, I think cybersecurity is turning into another topic where plan fiduciaries are a bit like people trying to put up wallpaper without tape or glue. Cybersecurity is an emerging topic, so they're trying to get that to stick to the wall while at the same time they're trying to get missing participants to stick to the other wall. It's one of many topics. It's not one that comes up at every meeting. You wouldn't have time to focus on the nuts and bolts of the plan, participant appeals, things like, is the plan serving its purpose? Yeah. What do your expenses look like? There's kind of core things for plans, and there's other things that are becoming more core. But I think we need to be mindful that, the more we put on a plan fiduciary's plate, the less time they're going to have for any of these things. and also the less likely it is they're going to want to be fiduciaries.
That's true. Yeah, it's if you suck up more time as somebody, well, first of all, they can't even do their job, right? I mean, if you're
Well, that's the thing. I mean, it's no, like in our American system where these committees are essentially teams of employees of the company that's sponsoring the plan. Yeah, if they don't have time to do their jobs, then why is the company sponsoring the plan in the first place?
Yeah, well, certainly a lot to think about, and you don't want to add to the plate, but certainly things you should be thinking about as a committee member, or for that matter, as a participant in a retirement plan, or just in general as a consumer, making sure that you're keeping track of your data and knowing how court cases are kind of winding their way through the court system and what conclusions they're coming to. Kevin, we're going to leave it there. Great to have you on solo. We'll look forward to having you back on next week. Maybe you'll be back with your partner in crime, and I mean that term very loosely. We'll talk to you very soon. Have a great weekend.
Thanks, Jeff. Thanks, listeners. Have a great weekend, everybody. Bye.
Bye, Kevin. Well, that wraps up this episode of BRN Sunday. I want to thank all of our great guests and contributors this week. Really appreciate them stopping by, and we appreciate you stopping by. Don't forget, tomorrow is President's Day. We're taking a day off. We'll be dark, but we're back again on Tuesday. I'll be joined by 7 Investing's Daniel Klein to look at the latest technology news. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.